when we think about the oncoming recession, we think about a consumer that might become a bit strapped. I get it. Like Apple's products are no longer this kind of high-end aspirational thing. They've become like sort of a utility, a luxury utility or whatever. And if that's how you want to explain it, fine, I get it. Okay. But I'll just say this is that when you think about the reliance on China and you think about some of the weakness that we've seen over there over the last couple of quarters, and you think about the manufacturing issues and supply chains and all that sort of stuff, to me, and I think you'll agree from a fundamental standpoint, we think Apple is vulnerable. But Carter, walk us through the charts here, because this move has been absolutely parabolic. It doesn't show any sort of fear about any of the things that we've just talked about, whether it be valuation, whether it be a recession here, whether it be some sort of geopolitical dust up between China and Taiwan that causes some sort of disruption to manufacturing, supply chains, nationalistic tendencies for products in China, that sort of thing. All of the fundamentals, as you would call them, out the window. Run us through the charts here. What are they saying to you?
Sure. So here's a chart with nothing on it. Kind of fun and always important to maybe start that way, because there's no bias here. Any line put on is a judgment. It's subjective. So here's the thing to note, of course, Apple's strength since Jan 1. It's impressive. Its multiple in the beginning of the year was 20.5. It's now 28. So that's called multiple expansion. And you need to deliver on the earnings front in order to justify that. Or, of course, the multiple contracts, all things held equal. But those blue arrows, this is very similar to my eye to the run-up in June. Take a look at the next iteration. The magnitude's quite similar, 36.5% versus 34. Now, this has taken longer. That was much steeper. Yes, this has taken more time, but it's analogous, I believe. Now, were we to break trend? So look at the next and what you've got here, and the angles are different again, because this has taken longer to get up to the 35% plus minus gain. But I put that arrow in anyway. I put a question mark to acknowledge we don't know that that's going to happen, but I think that's what is going to happen, and that we are ultimately, it would take a 2% move from here to get us down to that orange trend line, and ultimately, I suspect we break through it.
Yeah, and quickly, Jay Rice, who may be King Rice's brother. Anybody in the comments want to share who King Rice is? Feel free. I know Dan and Carter probably don't know, but he says what was breaking down 3 weeks ago, Merck, Amgen, UNH, J&J, is now bid, and what was breaking out, this is now breaking down, Apple, NVIDIA, Microsoft, and that's exactly right. Now, I will tell you something that Tim Seymour has said, I think correctly, Dan, that as long as the NASDAQ names stay bid, it's very hard for the broader market to, in fact, go down. But that seems all to be reversing. And you can see it just today in terms of what the NASDAQ's doing vis-a-vis what the Dow is doing. So it's just something to keep an eye on. Again, 1-2 days is not a trend make, but it certainly might be the beginning of something, Dan, Nathan.
Yeah, and again, it's just important to highlight the way Carter does the charts there. I mean, and Apple has been a very volatile stock, but it seems to be like a one-way train. It goes for like a couple months and it has a 30% move. I mean, Carter, when you see the largest equity, in the U.S. kind of trade that way, doesn't it just speak to a level of concentration? And Guy brings this up all the time. Apple's in hundreds of ETFs, so it's this function of kind of passive investing, right? And then over the last month during the banking crisis, I think it was this kind of flight to perceived safety, that sort of thing. That also presents like really big opportunities, right? And so again, I love the fact that you said a 2% move back to that uptrend. But then sometimes you'll speak in terms of like measured moves. What would your target be if it were to break that uptrend? And that could be by the end of the day, if you think
Sure.
about it, right? Where would you look to take profits if you were short this thing?
Right. We can pull the chart back up so people can see it perhaps as we go through it. But it is only 2% lower that gets you to the trend line and the prospective break in trend. You'll see it on the orange trend lines. And so if and as we get down to the orange trend line, I think we're headed there. And then in turn we break. How low might we go? I certainly think sort of 140, 142, not to be that precise, but down in there is a reasonable, And that would be just a minimum. Why can't you ultimately go to the low? Because again, if the multiple was 20.5, and now it's 28 on the lows of December, what if the earnings are light? What if it's a little bit unhappy? You can unwind. But the thing is that this is sort of, not to say idiosyncratic to Apple, because we know most importantly, it's happening in Microsoft as well, albeit not as steep. Holding aside NVIDIA, that is idiosyncratic right now and is sort of the poster child for AI and all this stuff. But the money flow, and it's the same thing in Microsoft, and these are the big ones, right? Is it really people embracing these, or is it a defensive posture? In principle, it's a defensive posture, just as you're seeing, Clorox and Procter attract capital. Good technique argues for being safe when things are uncertain. And while one could say, why is Apple safe or Microsoft safe? In principle, back to the ivory tower, back to the textbooks, a large cap versus small cap, low leverage, there's not a lot of debt in either of these, mature growth company is a safer place, all things held equal, than other areas of the market in the event of economic weakness. And so I think it's a defensive move. It's in many ways, we sent out a note to clients called the face of fear, that the actual moves up in Microsoft and Apple are not so much an endorsement of those names, but a money flow thing, people going to where they almost have to go, the high ground. And if you think about it, even they're so mature at this point, right? It's not a CRM, right? It's not NVIDIA. They're such mature growth companies. It's almost like people rolling back the clock and saying, I am so concerned, I'm going to just give all my money to John Rockefeller and Andrew Carnegie. I'm going to give all my money to Bill Gates and Steve Jobs. I know Steve Jobs is not alive, but that's the point, is that here, I can't come up with any other thing, all in. And that's not a particularly bullish thing.
I love Carter. We thought Apple could get down to 125 in the fall. It actually did, and it bounced. The bounce is more vociferous than I thought it would be. But if you look at a 50% retracement of this recent range, that 140 to 145 level makes a lot of sense.